Think your money's safe in the bank? Think again. Holding cash there might feel secure, but it's actually a financial trap. The truth is, stashing cash in a savings account is costing you more than you think. But Robert Kiyosaki has 6 better and safer asset options. In this video, I'll show you 6 alternative assets that Kiyosaki believes are not only safer, but also more profitable than cash. In the end, I'll show you an asset that has the potential to return over 50% every year and turn a $10,000 investment to over $700,000. But why do we need these options? Hello, the reason we need it is inflation. Every year, the cost of goods and services rises, meaning the value of your money decreases. If your bank's interest rates are lower than the inflation rate, which they often are, your savings are effectively losing purchasing power. For instance, if inflation is at 3% but your savings account offers only 0.5% interest, you're losing 2.5% of your money's value each year. This invisible erosion eats away at your financial security. You're earning next to nothing on your deposits while prices continue to rise. Essentially, the money you think is safe and growing in your bank account is actually shrinking in terms of what it can buy. It's a silent, steady drain on your wealth. Now, before introducing you to the top 6 assets that are better and safer than cash, let's set the mark to beat, which in our case is the return offered by a bank's savings account. Over the past decade, the average annual percentage yield, or APY, for savings accounts in the U.S. has generally been quite low, starting around 0.21% in 2010. It then decreased over the years, reaching as low as 0.06% by 2013 and remaining around that level until 2021. A slight increase was observed after that, peaking at around 0.47% in 2024, but rates have mostly stayed below a 0.5 percentage point in recent years. In fact, the average annual percentage yield on savings accounts in the U.S. over the last 10 years is approximately 0.19%. But is this our rate to beat? The answer is a resounding no, because the average inflation rate over the last decade sits at around 2.65%. So based on this, imagine you have $10,000 in cash and decide to keep it in a savings account. Over time, the value of that money would numerically increase, but overall actually lose value to inflation. Inflation acts like a silent thief, slowly eroding your purchasing power. Let's break it down further with some concrete numbers. Let's say you invest $10,000 in a savings account that provides an APY of 0.19%. After 10 years, your money will be valued at $10,191. However, due to an average inflation of 2.65%, you'll lose purchasing power by a total of $2,355. Therefore, the real value of your money after 10 years would be $7,645. So in a real sense, our mark to beat is the inflation rate minus the savings account return, which is 2.65% minus 0.19%. And that equals 2.46%. Coming up next are the assets ranked by their potential to beat that by a big margin, with one having the potential to exceed the bank savings account return by over 50%. I'll show this by demonstrating the projected returns of a $10,000 investment in each asset. Starting at number 6, we have Inflation Shield bonds, also known as Treasury Inflation-Protected Securities, or TIPS for short. These are a special type of U.S. government bond designed to help protect investors from inflation. Issued by the U.S. Department of the Treasury, TIPS are a secure investment option that ensures your money maintains its purchasing power over time. TIPS are structured to battle inflation by adjusting the principal value in line with the changes in the Consumer Price Index. When inflation rises, the principal of TIPS increases, making sure that the value of your investment keeps up with the increasing cost of living. This unique feature makes TIPS an attractive option for preserving the real value of your money over the long term. While tips typically offer lower returns compared to riskier assets like stocks, they provide a stable and predictable income stream. The average real return on tips, which is any return above inflation, ranges from 1% to 2% depending on the maturity and prevailing economic conditions. If you had invested $10,000 in tips 10 years ago, considering an average annual growth rate of 2%, your investment would now be worth approximately $12,190. This return outpaces the minimal interest rates offered by traditional savings accounts, which, as we established, only average around 0.19%. Regular interest payments are another key benefit of tips. They pay interest twice a year at a fixed rate, applied to the adjusted principal. As the principal increases with inflation, so do your interest payments. This provides a steady, inflation-protected income stream that can help meet your financial needs without eroding your purchasing power. The low-risk nature of tips is particularly appealing. As U.S. government securities, tips are backed by the full faith and credit of the U.S. government, making them one of the safest investment options available. This level of security is attractive to investors with a low risk tolerance or those seeking to diversify their portfolios with a stable asset. Tips are also accessible and tradable. They can be purchased directly from the U.S. Treasury at auction or through the secondary market. With denominations as low as $100, tips are accessible to individual investors looking to start small. Additionally, tips can be sold before maturity, providing a level of liquidity that's useful for meeting unforeseen financial needs. Next, at number 5, we have tangible wealth ground. Basically, that's a fancy way of saying land. Like real estate, owning land can offer advantages over keeping cash in a bank. Here are some reasons why. Over the past decade, the value of land has appreciated steadily. 10 years ago, the average value of an acre of land was $2,730. Today, that value has risen to $4,080 per acre, reflecting an average year-to-year growth rate of 4.1%. So if you had invested $10,000 in land 10 years ago, considering the average appreciation rate, your investment would now be worth approximately $14,945. This appreciation highlights the potential for land as a solid long-term investment. But land isn't just about appreciation. Depending on its location and characteristics, land can generate income through various means. You could lease it for farming, timber production, or even mineral extraction. For instance, agricultural land can be leased to farmers, providing a steady income stream. Similarly, land with timber or mineral resources can yield significant returns through sustainable harvesting or extraction. Flexibility and control are significant advantages of land investment. You can hold the land as it appreciates, develop it for residential or commercial use, or lease it for various purposes. This control allows you to respond to market demands and capitalize on opportunities as they arise. Unlike other investments where you depend on external decisions, land ownership gives you direct influence over your asset. Land also comes with lower maintenance costs. Unlike buildings or homes, vacant land typically requires minimal upkeep. There are no utility bills, mortgage insurance, or maintenance and repair costs. The lower cost of ownership makes land an attractive option for those looking to minimize expenses while still benefiting from the appreciation and income generation. Land is a finite resource, and its scarcity can drive up value over time. As population growth and development increase demand, land value is likely to increase as well. Additionally, like other tangible assets, land serves as a hedge against inflation. As the value of currency decreases, the price of land generally rises, preserving your purchasing power over time. However, investing in land does have its risks. Land values can fluctuate based on economic conditions, location, and changes in zoning laws or environmental regulations. Land is also less liquid than other investments, meaning it can take time to sell and convert into cash. Furthermore, generating income from land may require additional investments, such as infrastructure development or environmental assessments. Next, we have the safe haven asset, commonly known as gold. Throughout history, gold has stood as a symbol of wealth and security. Especially in uncertain times, it's often turned to as a reliable store of value. But why might gold be a better option than keeping cash in the bank? Let's break it down with some numbers. 10 years ago, an ounce of gold was worth $1,330. Today, it's valued at $2,301. This reflects an impressive average annual growth rate of 5.63%. If you had invested $10,000 in gold a decade ago, your investment would now be worth around $17,301. That's a return of approximately 73%. So that's good, but in the end, I'll show you an asset that has the potential to return over 50% every year and turn a $10,000 investment into over $700,000. Each year, as gold appreciates, the value of your initial investment grows at a steady rate. The growth isn't just linear, but exponential thanks to compounding. The longer you hold on to gold, the more pronounced this effect becomes, significantly enhancing the value of your investment over time. Adding gold to your investment portfolio also brings the benefit of diversification. Unlike stocks and bonds, gold's performance is not directly tied to financial markets. This makes it a valuable addition, helping to reduce overall risk. During periods of market volatility, gold often remains stable or even appreciates, providing a buffer against market downturns. Gold's universal acceptance and limited supply make it a solid choice. It's valued across cultures and has intrinsic worth. Unlike fiat currency, which can be printed in unlimited quantities, the supply of gold is finite. This scarcity helps maintain its value over time. Investors often flock to gold during economic or geopolitical turmoil, viewing it as a safe store of value. So when you think about securing your wealth, consider the time-tested strength of gold. It's not just about holding a precious metal, it's about preserving and growing your financial future in a way that cash in the bank simply can't match. Moving on to number 3, we have wealth-building property or real estate. Owning real estate has always been seen as one of the most dependable ways to build wealth. Unlike simply saving money in a bank, investing in real estate can yield significant returns through property appreciation, rental income, and tax benefits. Rental income is a game changer. Unlike the paltry interest from savings accounts, rental properties generate significant monthly income. This income can cover your mortgage, find further investments, or provide financial security. Tax benefits further sweeten the deal. Mortgage interest, property taxes, and maintenance expenses can be deducted from your taxable income, reducing your overall tax burden. In some cases, you might even qualify for capital gains tax exemptions when selling your primary residence. These tax advantages can significantly enhance your returns. Leverage is another powerful tool in real estate investment. By using a mortgage, you can control a much larger asset than you could with cash alone. For example, a 10% down payment on a $100,000 property means you're controlling a $100,000 asset with just $10,000. If the property appreciates by 10%, you've effectively doubled your initial investment. And if you look at the average 10-year growth of an average real estate price, 10 years ago, the average home in the U.S. was valued at $222,000. Today, that average has climbed to $419,000, reflecting an annual growth rate of 6.56%. But the real magic of real estate lies in its multifaceted returns. Real estate offers flexibility and control. You can improve the property, change its use, or sell it when market conditions are favorable. Unlike stocks or bonds, where you rely on corporate decisions, real estate allows you to directly influence the value and income potential of your investment. Real estate is also an excellent hedge against inflation. As living costs rise, so do property values and rental incomes. This inflation-adjusted growth ensures that your investment maintains its value over time, preserving your purchasing power. However, real estate isn't without its challenges. Property values can fluctuate, and real estate is less liquid than other investments, meaning it can take time to sell. Managing rental properties also requires time, effort, and dealing with potential tenant issues. Despite these challenges, the potential benefits of real estate make it a compelling choice. It's not just about owning property. It's about creating a sustainable income stream and building long-term wealth. Now, before showing you our number one asset that has the potential to turn a $10,000 investment into a $700,000 value, at number 2, we have the Market Titan Fund that is the S&P 500 Index. The S&P 500 Index is a collection of the 500 largest publicly traded companies in the United States. Think of it as a snapshot of the American economy, capturing the successes and challenges of a diverse range of industries. For decades, this index has consistently provided solid returns, far surpassing the modest interest earned from traditional savings accounts. It's a powerhouse of growth, driven by the performance of industry giants like Apple, Microsoft, and Amazon. By investing in this index, you're essentially buying a piece of these companies and sharing in their success. The compounding effect here is extraordinary. Dividends are reinvested, adding to your principal and generating more returns. Over time, this compounding can lead to exponential growth, far outpacing the returns of a traditional savings account. Diversification is another critical advantage. With the S&P 500, you're spreading your investment across 500 different companies in various industries. This diversification reduces risk because if some companies underperform, others can pick up the slack. This balance helps protect your investment from significant losses, making it a safer bet compared to investing in individual stocks. Also, inflation protection is built into the S&P 500. As companies increase their prices to keep up with rising costs, their revenues and profits grow, boosting their stock prices. This natural inflation hedge means that over time, your investment in the S&P 500 can help preserve and even increase your purchasing power. That's why, historically, the S&P 500 has outperformed traditional savings accounts by a significant margin. Over the past decade, the asset value of the S&P 500 has increased from $1,985 to $5,477.90. That's an average increase of 10.68% each year. Let's look at a practical example to show the potential of investing in this asset. Suppose you invested $10,000 in the S&P 500 10 years ago. That investment, after 10 years, would be worth approximately $27,596. You can easily calculate this by using the formula of future value, which is future value equals the present value multiplied by 1 plus R to the power n, where R is your return from the asset while n is the number of years. Real quick, if you're into stocks, index funds, ETFs, or REIT investments for dividend income, check out our channel. We extensively cover topics from reaching $10 million in valuation to earning millions in dividends. Of course, no investment is without risk. The stock market can be volatile, and the value of the S&P 500 can fluctuate. Economic downturns, market corrections, and changes in investor sentiment can all impact performance. But over the long term, the S&P 500 has consistently delivered strong returns, making it a robust choice for wealth growth. So if you're looking to turn your savings into a dynamic, growth-oriented investment, consider the S&P 500 Index. It's about more than just the numbers. It's about partnering with the most successful companies in the U.S. and riding the wave of their success. Finally, topping today's list from Robert Kiyosaki, offering a higher return based on percentage, is the infamous digital gold, the Bitcoin. Bitcoin has emerged as one of the most intriguing and potentially lucrative investments of the past decade. Often referred to as digital gold, Bitcoin offers unique advantages over traditional cash savings with a remarkable track record of growth. In fact, the value of a single Bitcoin recently hit over $60,000. So what's the secret behind Bitcoin's value? Its scarcity plays a significant role. Bitcoin's supply is algorithmically capped at 21 million coins, which means that no more than this amount can ever be created. This built-in scarcity is intentional to preserve its value like that of precious metals like gold, driving up demand as more people become interested in owning a piece of this digital asset. As demand increases, so does the value of Bitcoin, making it a potentially lucrative investment. Bitcoin also offers decentralization. Unlike fiat currencies, which are controlled by central banks and governments, Bitcoin operates on a decentralized network. This means it's not subject to the same inflationary pressures and monetary policies that can devalue traditional currencies. This decentralized nature of Bitcoin also provides a level of security against government interference or manipulation, making it an attractive option for those seeking financial sovereignty. And Bitcoin's performance has been nothing short of extraordinary. 10 years ago, the value of a single Bitcoin was around $818. Today, that value has skyrocketed to approximately $61,082. This represents an average year-to-year growth rate of 59.93%. If you had invested $10,000 in Bitcoin a decade ago, your investment would now be worth a staggering $746,729. This incredible appreciation highlights Bitcoin's potential as a high-reward investment. However, Bitcoin's volatility is a significant consideration. While Bitcoin has shown substantial long-term growth, it's also known for its short-term steep price fluctuations. The value of Bitcoin can swing dramatically in response to market sentiment, regulatory news, or technological developments. This volatility means that while Bitcoin offers the potential for high returns, it also carries a high level of risk. Thanks to the wisdom of Robert Kiyosaki, these are all very good options, but they don't pay you a regular monthly income to live off of. To get paid over $8,000 in monthly dividends, click the video on the screen.